Investment term for the day: structured investment vehicle.
A structured investment vehicle is a pool of investment assets that attempts to profit from credit spreads between short-term debt and long-term structured finance products such as asset-backed securities, ABS. A structured investment vehicle is a type of special purpose fund that borrows for short-term by issuing commercial paper in order to invest in long-term assets with credit ratings between AAA and BBB. Long-term assets frequently include structured finance products such as Mortgage-Backed Securities (MBS), Asset-Backed Securities (ABS), and the less risky tranches of Collateralized Debt Obligations. Funding for SIVs comes from the issuance of commercial paper that is continuously renewed or rolled over. The proceeds are then invested in longer maturity assets that have less liquidity but pay higher yields. The SIV earns profits on the spread between incoming cash flows and the high-rated commercial paper that it issues. For example, an SIV that borrows money from the money market at 1.8% and invests in a structured finance product with a 2.9% return will earn a profit of 2.9% minus a 1.8%, and that's equal to a 1.1%. The difference in interest rate represents the profit that a SIV pays to its investors, part of which is shared with the investment manager. In effect, the commercial paper issued matures sometime within 2 to 270 days, at which point the issuers simply issue more debt to repay maturing debt. Thus, one can see how structured investment vehicles often employ great amounts of leverage to generate returns. These financial vehicles are typically established as offshore companies, specifically to avoid regulations that banks and other financial institutions are subject to. In essence, SIVs allow their managing financial institutions to employ leverage in a way that the parent company would be unable to do due to capital requirement regulations set by the government. However, the high leverage employed is used to magnify returns when coupled with short-term borrowings, and this exposes the fund to liquidity in the money market.
And that was your investment term for the day.